Very good afternoon, good morning. Welcome to the live risk event for the non-farm payroll. Hope everybody's doing well and that you can see my screen and hear my voice okay. Just going to make sure I get everything set up. Turn the video on. There we go, folks. Hey, Devon, great to see you. Hope you're doing well. Hey, Shauna. Thank you very much. Absa, Ali Antonio, always. Daniel, Dave. Hi, Lane. Sergey, good to see you. Mark, Zet. Okay. Hope everybody's doing all right. Okay, very good, everybody. All right, super. Right, without further ado, hey, Paul, good to see you. Let's get stuck into the session. So, it's a big day today. We had a very nice tradable event last January for the last NFP event, and we met very well. Might get another one today. There's one slightly tricky aspect of today. And do you remember last August, the Bureau for Labor Statistics revised down US jobs by about 818,000? Well, it was 818,000 in total. Now, there's another revision coming out today. Now, last time that revision sort of came out in a sort of staggered approach, so it's quite complicated. Um, I think so, Dave. I'm not sure. I think it is. Just double check with support. I don't normally look at the recordings necessarily. But the point is that we've got that revision today. Now, the Bureau for Labour Statistics have said that they realised that last time was a mess up the way that the data was released, so they want to get it right and they want to release the data at the same time as the non-farm payroll print. So hopefully we're going to get that, but just be aware there's that slight caveat. We'll have the squawk on.
Next up in 10 minutes' time at the bottom of the hour to have the latest labour market report.
We'll have the squawk on, right? And just be listening out for that. I'll have it on. We're looking for that Bureau for Labour Statistics revision. So in other words, if we get very strong jobs and then suddenly, you see the move might pare back a little bit if there's suddenly a massive revision downwards. If the revision is higher for the jobs, right? Higher than that's and the print is high, then that'll give it a little bit of an extra push. So just keep that in mind. Right. Without further ado, where are we? What's going on out there, and what's the thing for us to look at? So, big picture, December. Fed had their summer of economic projections. Importantly, do you remember what they revised? They revised inflation higher, and PCE, core PCE both up, more than markets were expecting, and they gave a higher for longer rate path. That sent the E-mini moving sharply lower, right? And the dollar moving sharply higher. Just go back here, have a little look. 18th December, that's that. That was the Fed decision. Okay. We're now back to a very similar place in terms of price. But that big drop down, just that is what the market thinks when you have a higher for longer narrative. Okay. And you can see here what E-mini fell nearly 4%, right? On that summer of economic projections. So Powell has said that the labour market conditions remain solid, they're broadly balanced, and he repeated that it was not a source of inflationary pressures, adding that job creation was a level that would hold the unemployment rate steady. So Powell's not worried about job market being inflationary, but the market still will read it through that lens. Because if everyone's in jobs, that means that they can spend their wages, and if wages are rising, they can spend those wages paying higher prices. So it's broadly inflationary. Yesterday, we also had news that Scott Bessent said that that Trump hasn't forgotten his strong dollar policy. He still likes that. They're going to pursue lower interest rates through less expansionary fiscal policy, and less inflationary trade policy. We've seen that in the tariffs. He hasn't hit, 50% tariffs with China and all that. He's trying to keep inflation, thank God, literally, because if he'd gone in that really inflationary path, then it would have been difficult for everyone in the Western world, right? Everyone in the whole world. So he hasn't done that, and that's good news, right? Less inflationary trade policy, aka less tariffs. However, right, the jobs market is going to be really crucial to set the tone for the Fed and what they do. If you look at current expectations, see, currently they're expected to hold in their March meeting, and at 4.375%, they're only expected to cut about twice this year. Okay, so two more rate cuts roughly this year. Now, that higher for longer path, if inflation is as it is and the jobs market is strong, you might argue that this is not very restrictive, right? So in other words, the Fed might look at this again and say, hang on, maybe this isn't restrictive this level because we can still growing and the job market's still strong. Maybe we need to stay either higher for longer or maybe even start to consider an interest rate hike, right? So that's the kind of mood that we find the market in. So what does that mean? Okay, look at jobs openings, the JOLTS jobs that we had, right, for December. Jobs openings are weakening. There's a slight weakening in the labor market. Look at the ADP jobs that we had out early in this week, still robust. Okay, slight weakening, but still robust for the ADP jobs number, sets the mood for Friday. The headline, massive surprise for in the January print, 256,000 above market's maximum expectations. So that's like just flatlining the labor market, okay, keeping it pretty robust. Um, Today, it's expected to be 170,000. So expected to be a drop. But if we start seeing that staying up at those 200s, okay, then that's really going to be dollar positive in terms of the headline. We need to see everything aligning because we don't want to take uncertain trades, right? Um, but at the same time, just making sure I've got my right account set up. There we go. But at the same time, just keep that headline is going to grab all the attention. Don't forget the revisions as well. Okay. Now we've also got the average hourly earnings. Okay. Still fairly robust, 3.9% year on year. And we've also got the unemployment rate. Remember the Fed, it's 4.1%. The Fed are expecting that to tick up, I think, at 4.3%. You can see here, yeah, they're expecting it to tip up to 4.3% this year. It's currently at 4.1. So, firmer than they're expecting. 4.2 for 2024. Look, 4.1. That's good, right? Strong labor market. So with all that being said, this is what we need to look for. First of all, headline. If the headline comes in 251,000 or 250,000 or higher, and the unemployment rate comes in 4% or 4.1% will do, honestly, today. Because if you get a beat there at 251,000, that's 4.1%. That'll do. Average earnings, you want to see that coming in. We want to see that coming in high, 3.9%. Take out all doubt, right? So here, 251. Unemployment rate, 4.1 will do. Here, the average earnings, we want to see that 3.9%. So above expectations, maximum above for the average earnings. That will do the job. You would anticipate dollar strength, right? So you'd be looking for euro dollar selling. I would play dollar yen upside. That would be my preferred opportunity. So in terms of the currency space, it'd be dollar yen upside, euro dollar downside, and then in the stock market, it would be the E-mini S&P 500 lower, right? Don't worry, I'm here. I'll be making sense of as the data releases, right? But that's the thing. Now, the other opportunity, if this is a big miss, right, that will surprise markets. If this is like 59,000, unemployment rate 4.6% or 4.5%, 4.3% would do. So 59, 4.3%, because that's what the Fed's target was, right? Average earnings, if you see that coming in 2.6%. So if we surprise across the board, then look for heavy dollar selling. I would look for euro dollar upside, pound dollar upside, or Aussie US dollar upside. They will be all fine today. An S&P 500 gains. You'd be expecting like maybe 1.5%, 1% gains. Why? Because it means the Fed will be more likely to cut interest rates. All of a sudden, the US economy is much more restrictive than they thought. Things to note: always check out revisions. So if you just see the headlines, flick your eyes to the right. Just check the revisions are either as before or revised in line. Now, if that's a revision of like 1,000, fine, it'll be ignored. But if that's a big revision, right, 20, 30,000, just make sure which way it's going. Is it in line with the headline or is it contradicting it? Second point, we've got Canadian jobs data at the same time. So if we see strong NFP, weak Canadian data, look for dollar CAD upside, right? If we see very weak Canadian data, right? So weak Canadian data, right? That will be CAD downside. And then we'd need to look for a strong currency on the day. And so that would be, it's tricky. The dollar will be impacted by the headline. So if we see very weak Canadian data, and if we see weak NFP, let me just work this out. If we saw weak
So
NFP
just 1 minute
print,
now on the US and Canadian labour market reports.
that
Again, I'll
would
lead the
be,
headline non-farm payrolls forecast at 170,000. I'll move on to the unemployment expected at 4.1%. I'll then move on to any revision to the headline, the earnings components, which includes month-to-month and year-over-year, then work week hours, the participation rate, and if we get them, I'll give
yeah,
you a
that'd be
mention on
CAD
the
yen sterling.
revisions. We'll then jump over to Canada,
Right.
but I'll look for the employment, the full-time,
I'll
part-time
talk you through it as
breakdown,
we go. Right.
unemployment rate, and the wages.
So if it's
Then
weak
move on to
CAD
the
and weak
SES
NFP, it'd be
reports.
CAD yen selling.
30 seconds.
Hang on, just hold fire on that one. It wouldn't be. Right. Hold fire on the weak NFP, weak CAD. I'll go through that if it is the case. Otherwise, let's just focus now on the headline. Headline print first off.
10 seconds.
Really hot print. Then that would be dollar strength. S&P 500 selling. Dollar yen upside, euro dollar downside. Here we go. And what do we see?
143. That's 143
Okay.
below the expected of 170.
Mixed. It's not a
Unemployment rate
trade,
4%
right? It's
below
mixed.
expected 4.1.
Look at
The
this.
prior
Look
that's
at that
priced
revision.
higher,
Massive higher.
307.
Big
Earnings month
revision.
to month at 0.5 above expected
Really mixed print.
0.3.
Stay out.
Year
Stay
to year
out. Stay
also
out.
firm
Stay
at
out.
4.1 above expected
Right.
3.8. Work week hours 34.1 below expected
That's just so choppy.
34.3.
Right. Let's look at this. The headline below forecast. So that's positive for stocks. But the prior revised higher, 307,000. Right. That is negative for stocks. Higher payrolls, unemployment rate. Look at that. That's negative for stocks. Average earnings. Right. That's negative for stocks. So broadly speaking, that's negative for stocks. That's a dollar positive. It's that that's thrown the markets out, right? So we're seeing a bit of choppy action, but it's mixed. You see the problem. So if you look at the S&P 500, you see it's down, right? And the reason it's down is because broadly that does support stock downside. You'll see the dollar should be broadly higher, which is euro dollar down. Let's just find that. Here we go. Right? Dollar strength on that. It makes sense, but it's too choppy, right? And you see why it's too choppy because that actual print. If that was, a little bit higher, that would be much clearer. Now let's just see if there's the revisions out. It's not a trade, but let's keep making sense of it.
Slight dovish tilt to this release on account of the unemployment rate and the wages.
Yeah,
And as such, you have seen treasuries at fresh session lows.
so they're just
There's been a
saying
pick up here in
the dovish tilt is because of this. This is hot, much better than the Fed were expecting. This is hot, much higher than all analysts were expecting. That's a hot revision, but that's not.
compared to July pre-release, and in terms of year end, around 40 basis points of easing, that synced to 43 pre-release.
Right. So if you were, if you were cheeky, any short-term opportunity, euro dollar downside, S&P 500 downside makes sense, but there's nothing to trade with. There's nothing like no-brainer trade, nothing to get into. Okay. Now the Canadian employment data, let's check this out. This is higher than markets are expecting. So labor market stronger. This is towards the high end, and the prior is revised higher. So that's CAD. That's CAD strength. So we've had CAD strength. So it's not, it's US dollar. CAD strength, US dollar upside. So it's euro downside. So euro CAD. And no, there's not a trade there. Just see how the euro CAD's reacting. Yeah, so you're getting that euro CAD downside, which makes sense, right? Because the euro is down on the stronger dollar and the CAD is up on the stronger Canadian jobs. So arguably, if you were sort of more nimble, euro CAD downside makes sense, maybe from the pivot point, but it's not a trade I'm taking. Um, CAD yen upside, well, you've got dollar strength, so that's yeah, CAD yen upside would make sense as well. Thank you, Karen. Yeah, CAD yen upside makes sense for the same reason. CAD upside, stronger dollar, that is bid into US Treasury. So CAD yen upside is a legitimate bias. Euro CAD downside is a legitimate bias. Okay. Nothing like, however, for me, right, and you've got these revisions around. Let me just have a look. Right. Right. So here I've got the revisions coming out. Let me just talk them through with you. So BLS revisions. Adjusted non-farm employment for March revised downward by 589,000. Non-season adjusted revised down by 580 out 98,000. So right, so it's revised the over the year change from 2.9 to 2346. So on balance, it's slightly firmer than probably markets were expecting, but only just. If that print had come in
In the
hot,
FX spaces, we're
that would have been
worth
good.
observing some of the strength we are seeing in the Canadian dollar, which is actually able to outmuscle its US equivalent. Do bear in mind there was quite a beat on the headline for employment change, relatively even mix between full-time and part-time, and employment rates that fell unexpectedly fell to 6.6%.
Yeah, Daniel, yesterday you had Amazon earnings coming out after the close, and we had some Fed speakers, and there was some Trump tweets and Scott Bessent saying stuff. All of that was just chopping the E-mini around yesterday. We had Amazon earnings after the close yesterday as well. All right, so arguably you've got CAD yen upside, stronger stronger jobs and weaker yen on this stronger US job. So CAD yen upside or Euro CAD downside. But it's not a trade that I'll be taking, right? I would expect the E-mini to be pressured today on that, right? You would expect that. So selling is what you'd expect. But just keep in mind the caveats I've already said, all right? Um, okay. Nearly there. If that was green, that would have been a no-brainer trade, right? But it's not. Next week, got US CPI, we got Swiss CPI, we got UK GDP. All three of those are good events, and all three of them have the potential to move markets significantly. So there's nothing for today. As I said, if you're desperate to trade it, Euro CAD downside, CAD yen upside are legitimate, but it's not something I'm looking to get involved in. And I'll be watching to see how the E-mini reacts to this print. Slightly firmer, so I would expect downside to dominate. All right, folks, that's all for now. We'll be back next week. Have a very good weekend. Cheers now.